Okay, you are live. If you want to get started, Angelo and Ellie and others, we're set.
Okay.
Very good.
So many thanks. Maybe we take like a first round of introductions, at least of the presenters. So welcome everyone to the workshop on experimenting on central bank digital currencies using Hyperledger technologies. I'm Ellie Androulaki. I'm a distinguished engineer at IBM Research, driving the decentralized trust activities at IBM Research and globally. And we have two more people from IBM Research here, Angelo De Caro and Kautar El Kiyawi, who will introduce themselves. But we also have people from Banque of France team that will present the experimentation we did around Venus, and they will give more information on this. With no further delays, I will hand over to the rest of the people to introduce themselves, and then to Clement and Corentin to start off with the central bank digital currency definition requirements and the context of Venus project.
I can go next if you want. So, yeah, I'm Angelo De Caro. I'm a senior technical staff member at IBM Research Zurich, working with Ellie on decentralized trust. Maybe some of you knew me also because I've been for 3 years and the TSC, the technical committee of Hyperledger, the Hyperledger project was really a lot of fun being there. And I'm one of the, as you know, I'm one of the architects of Hyperledger Fabric as well, and the token SDK that we will see today. Thank you.
Okay, so I am Kautar, and I am a research staff member at IBM Research. And yeah, with Angelo and Ellie, we've been working for the last few years on CBDC and blockchain.
Hello everyone, I'm Clément Delano, and I'm working at Banque de France since 2020 as a blockchain expert, mainly on central bank digital currency subjects on the IT side.
And hello everyone, very glad to be here to present our work. So I'm Corentin Simon, also working in Banque de France since 2 years on blockchain subjects, and more especially on CBDC. Yeah, let's go on the presentation. So let me, or maybe I think everyone has just to introduce himself. And if it's the case, I'm going to try to share my screen. Please feel free to confirm if you're seeing my screen correctly.
You can see it, yes.
Okay, perfect, thanks.
We can start. Welcome to this presentation about the Banque de France Venus experiment that was conducted as part of the Banque de France wholesale central bank digital currency program. In that context, we used a Banque de France DLT named DL2S and based on Hyperledger Fabric to issue and manage CBDC. We will start this presentation by introducing some key concepts and definitions about money and CBDCs, and we will give you some background on the Banque de France experiments. Then we will present you the DL2S DLT that we used on many of our experiments.
We can barely hear you, sorry to say, but we can barely hear you.
Yeah, your audio is a little low.
Can you speak closer to the mic?
We are not able to hear you
when I was speaking, or it's really a micro issue.
That sounds better.
Okay.
Okay, so maybe I can speak louder. Can you hear me correctly? Can you hear me?
Yes,
Yeah.
much better like this. Thank you.
Yes, yes, like this it is much better.
Okay, thanks. We will start this presentation by introducing the key definitions and concepts about money and CBDCs, and we will give you some background on the Banque de France experiments. Then we will present you the DM3S DLT that we used on many of our experiments, and after that we will give you feedback on the Venus experiment that was conducted in a partnership with Banque Centrale du Luxembourg and Goldman Sachs in 2022. We will conclude with some highlights and lessons learned from Venus, but also from other experiments.
So Clément and myself, we are part of the BDF blockchain team. So it's a team of 9 experts. So we are only 2 of us today, but we are 9 with various skills. And this team was created in 2021 to assemble most blockchain skills and capabilities to support initiatives and around blockchain and DLT internally. So we officially, the 2 of us joined at the launch, but Banque de France is working on blockchain technologies and DLT since 2016 with, for example, the Madre project that was built with Ethereum. And we are mostly working, as we said, on CBDC subject because it's obviously a hot topic currently, but not only. And we have multiple activities from blockchain education within Banque de France or also toward the outside world. With consulting in studies with where we are trying to technically, from a technical perspective, digging into some interesting subject about the ecosystem. Prototyping from POC to MVP. With 3 main activities, the technical design and architecture, the audits with code, smart contract and architecture, but also the development on mainly 2 big technologies that are Ethereum and Hyperledger Fabric, but also full stack deployment because we all know, I think, on blockchain projects, it's not only the blockchain that we have to build. So to better understand and introduce CBDC, let's try to have a more global vision about the different forms of money currently and their purpose, at least on Eurosystem framework. So it's a quick introduction just to have a better visualization for everyone. But we have 3 different big kind of actors. So we have the central bank that is issuing and guaranteeing the 2 different forms of currency depending on the actors. So we have the fiduciary money, that is the cash, the coins and bills that we are using for payments. That is a physical form of this money. But we also have scriptural money, that is on commercial banks accounts with the central bank for interbank settlements. And so, depending on the reserve that the central banks have, they can issue another form of commercial money this time. That is another form of scriptural money, but it's customer accounts that customer has at the commercial bank. And it's the digital form that we know in our bank account correctly. And the convertibility is assured between all those kind of money, of different forms of money, which makes the system works. For instance, 1 bill of €1 is equivalent to €1 in a bank account. So it's for that this distinction is not very well known, I would say, but for a good reason, is that because the convertibility is fully assured. thanks to this means. So blue boxes is central bank money, and the purple one is commercial bank money. And here's the concrete distinction between those two kinds in the economy currently. And so it's the global vision to better apprehend and understand the current context and the place that could take the CBDC in the next months or years if we are going until building those kind of systems. So CBDC would be a new form of central bank money alongside banknotes and deposits held by commercial banks at the central banks. So two forms, like the central bank money that we know currently, the retail CBDC that will be used for day-to-day payments between economic agents. It will be a digital version of banknotes that currently are only physical, with the aim to be more efficient and to serve as alternatives with the declination of the use of the cash. Because currently we don't really have a digital version for retail central bank money. We have one version for the commercial bank money with bank accounts, but not for the money that is issued by central bank. So it's very important, an important point, having in mind that's the only direct link with the public, from the central bank to the public. The other goal is also to foster innovation in payments for more secure, efficient, and inclusive systems for users. On the other side, we have the wholesale CBDC with another context, because we already have a kind of a digital form with the scriptural money, the blue box that we had on the right at in the previous diagram, that was represented by accounts of commercial banks within the central bank. And so here it's more to support the tokenization of finance, which makes central banks review the central bank money services they are currently providing, with the aim of adapting them to this new digital age and the possible associated development of the tokenized finance by offering a safest and liquid settlement assets. But also to support technological progress to enhance market efficiency while ensuring their stability. So three different objectives that would be the goal, I would say, of those kind of technologies. So first of all, the monetary sovereignty, that is an important topic today at the European level. Cross-border payments improvements, which can obviously be improved, but even though the DLT is not the silver bullet here, but it could help to rethink the systems that we currently have. More availability with 24/7 and each and every day of the years. Maybe having some programmability, at least it's possible on money and/or payments, and adapt to the new infrastructures that are currently built by the ecosystem. And just to visualize a bit more where we are standing currently, so we are working in Banque de France in the two subjects, but today we will be more focusing on wholesale CBDC, because the Venice experiment it's in this context, and it's the experiment that we are going to go more deeper in this presentation.
Now that we have introduced the key definitions and concepts about CBDC, I will share with you some context about the Banque de France experiments program. In 2020, Banque de France has published a call for application with the aim of carrying out a series of experiments. Three main objectives were identified at the time. The first one was to explore how conventional use cases for central bank money can be achieved through CBDC on DLT. And more precisely, we showed how to ensure self-management of central bank money on DLT technologies. And we tested use cases for wholesale CBDC, such as delivery versus payment for settlement of financial transactions, and payment versus payment for cross-border payments. The second objective was to identify the benefits of introducing a CBDC for the current ecosystem. and identify too how CBDC might foster financial innovation. And to achieve that, we analyzed the results of the experiments with regard to the existing ecosystem, and we compared performance, efficiency, security, and foreseeable productivity gains. The last objective was to conduct an analysis of the potential effects of introducing CBDC on financial stability, monetary policy, and regulatory environment. And Banque de France investigated what could be the impact on monetary policy transmission and examined the possible restriction imposed by a current legal and regulatory framework. And to summarize the objective of Banque de France with this call for application, it was to conduct real life experiments with the financial industry and within the existing legal framework. And this call for application received a great success with a strong response from the ecosystem. We received more than 50 application filings with a broad business and technical coverage. From a business point of view, we received responses from a wide variety of actors, such as banks and fintechs, from around the world, and with diversified proposals. On technical side, these experiments enabled us to explore important topics such as performance or scalability, but also privacy and interoperability with public or private DLTs or with legacy systems. And this call for application allowed Banque de France to lead 9 experiments between 2020 and 2021. And there is a public report to summarize what we learned from these experiments that was published in November 2021. And a new series of experimentations started on 2022 and is still ongoing. It focuses on cross-border payments and cross-platform DVPs. And the Venus experiment that we will present to you in a few moments is part of this new series.
So in the Venus experimentation, we used Banque de France asset which is called DR3S, so digital ledger for settlement securities settlement system. Sorry, that is an innovative DLT solution for financial transactions proposed by Banque de France for wholesale CBDC. So this platform has multiple capabilities. So first of all is the digital asset issuance and distribution. The platform allows to create and distribute assets in a digital form, such as money with CBDC, but also securities in the forms of tokens. We also have asset custody, where assets live on the blockchain platform and are custodied by managers that are ensuring the proper accessibility and security around the digital assets. All the life cycle and events about those digital assets are handled on the platform, obviously. We have different type of transactions, financial transactions, I would say, from DVP, delivery versus payment that Clément mentioned just previously, and also maybe too complex transaction to mention here, but multiple kind of transaction can be handled, but also the CBDC issuance, transfer, and redemption, obviously. Based on specific workflow for each types of transaction to go through, build on the different smart contracts. And we also have some optimization mechanism, for example, recycling, trying to automatically settle every eligible instructions that are not already settled if needed. And so I mentioned smart contract chain codes. It's because all those things are built on Hyperledger Fabric, so decentralized permission blockchain network that I think everyone around the call here already heard about at least. And it was built with an hybrid cloud deployment philosophy where the solution can be deployed everywhere. and anywhere, with an idea to have interoperability with legacy systems, but also other blockchain protocols. We have several differentiators for this platform. For example, the simplification and automation of the different processes, financial processes that I mentioned just previously, with reduction in processing times compared to what we currently have in legacy systems. Counterparty risk reduction with atomic transactions thanks to the DLT technologies, but also the use of central bank currency. Multi-currency is possible on the platform, but also cross-border payments. And the platform was built in an eco-friendly way. For the technical part, it's a fully decentralized solution. I'm gonna show why afterwards, but it's in the blockchain philosophy. We have confidential and anonymous transactions, but that can be also auditable thanks to specific technologies that I think Eli, Angelo, and Kauta will speak more deeply after us. We also have pretty good performance and scalability, at least on the wholesale context, and connectivity with legacy infrastructure and interoperability with other protocols. So it's an asset that was built and improved over the years through experimentation within Banque de France, but also with external partners. In particular, there were two experiments with one with Euroclear and one with HSBC that were part of the first phase, but also the Venus experiment, which is our main topic of discussion for today. And it will continue this year, obviously, with the pilot regime, European pilot regime, that should come. So let me present you more simplified technical stack about the application to have a better visualization of it. So the first layer is the business features. So it's in a user interface that is built in Angular. So it's a BDF interface proposal, but finally this one can be modified, adapted to specific needs for the participants, for example, or integrated into their own system, thanks to the implementation of the backend of the solution. Because as you can see, all those things are accessible via APIs, allowing different participants to access and or push informations according to their roles, and interacting with the different backend services of the application, where all the logic is developed in store with a service-oriented architecture. All those things are built in Golang, sorry. We also have tools like classical, I would say classical authentication stack for managing the users of the application, storing their credential and managing their rights on the application. We also have the FSC FTS stack, which will be presented more in details later in this workshop, to allow us to make off-chain interactions in the context of DL3S between participants, while having a token implementation with privacy and auditability, thanks to zero knowledge asset transfer, the ZKET implementation. And we are also using the HLF SDK Go to interact with the protocol layer, sorry, that is Hyperledger Fabric, using IDMX, which provides strong authentication as well as privacy preserving features such as anonymity and linkability. We are also using a form of private data to allow sharing of private but verified informations between different parties. We are using Raft as consensus for the ordering service part, and CouchDB as worsted for for rich queries. And finally, all those things are deployed on cloud infrastructures in Docker containers that are orchestrated via Docker Swarm. So as I already mentioned, it's a service-oriented architecture with a multi-cloud setup that is possible. We've done some performance testing, but it's more focused on HTLF, not DL3S as a whole, but on HTLF. It's something it's up to 2K TPS, so pretty good number, at least for the protocol layer part. And we have interoperability, so to name a few with traditional platform, so target 2 securities, that is a European legacy system that's offering centralized delivery versus payment settlement, having cash and securities on the same platform. So a legacy system, European system. Sorry for that. But also market DLT with Corda and Fabric, with Hyperledger Weaver, and HTLC APIs with the Venus experiment.
Now that we have introduced you to DL2S, let's dig deeper into the Venus experiment. 100 million euros of an unlisted digital bond were issued by the European Investment Bank on the securities DLT operated by Goldman Sachs. The settlement was done in a CBDC issued by the Banque de France and the Banque Centrale du Luxembourg on the BDF settlement DLT, namely DL2S. And you can see at the bottom right the full list of the participants of this experiment. In addition to the already mentioned participants, there are the Société Générale and Banco Santander commercial banks. Société Générale has contributed to the experiment as a custodian and Banco Santander as an investor. The other investors were AXA and Union Investment. And Venus was an innovative experimentation on many aspects. We allowed 2 central banks to issue a CBDC on the same blockchain network. The execution of the DVP was automated between 2 blockchains of different technology without the intervention of a trusted third party. And we implemented with success the HTML block.
Okay, so I've been working on something and I wanted to be showing you. Yeah. So, are you ready? Yeah. How much you think?
Sorry?
So someone is speaking. Okay. Yeah, so I was saying that we implemented with success the HTML block contract, or HTLC, interoperability standard, which ensures the atomicity of securities and cash movements under certain operational assumptions. And we will detail this precise points later in our next slides.
So, sorry for the interruption. I have some issue with my voice currently. It's maybe to try to speak loud. Hopefully it's gonna stay fine until the end of the presentation. But so let me quickly go through the network topology that we use for Venus experimentation. So we retrieve the different participants that Clément mentioned just before. And so we have different participant types that are possible in the DL3S network. So we have the 2 central banks, Banque de France and BCL, the 2 custodians, Société Générale and Goldman Sachs, that are blockchain participants on the network. So they host a blockchain node of the network and therefore has access to the ledger. So if we come back to the technical stack that I presented previously, they finally are hosting every layers of the stack, obviously. We have EIB, so the European Investment Bank, that is a direct participant. So all the layers, but no blockchain nodes, so no Hyperledger peer. And is connecting via the node of another blockchain participant. In this case, it's Banque Centrale du Luxembourg, to retrieve and push the necessary information to the DLT. And finally, we have the investors that are indirect participants, so they do not host anything, but access the application by connecting directly to the system of the dedicated blockchain participants. Here, they are custodian. So as I already mentioned, we had Raft implementation as for the ordering service with a free order nodes distributed on the network that are not represented here because it's more technical nodes for making a Hyperledger Fabric working, but it was 3 different instances those that we are seeing currently. And for the hosting part, for DL3S at least, we have different modes. We can host all those networks in one instance for testing purposes generally, but we can distribute all those participants in several instances to having a real to achieve the main goal of the decentralization, I would say. And the hosting is also possible to be distributed from BDF complete hosting, BDF hosting all the participant stack on its own cloud to the independent hosting of the stack of the different participants. For instance, Goldman Sachs could host its own node and interact with the others that could be hosted somewhere else. So, and just to make some context here, for various experiments, we used multi-instances configurations, but it was all hosted on monocloud with a monocloud hosting at Banque de France. Even though it's something that we already did, the multi-cloud hosting I'm mentioning, in other experimentations.
I'm going to explain the general HTLC mechanism. Here we have 2 distinct blockchain networks. The securities network on the left, called Network 1, and the cash network on the right, called Network 2. Cash and securities stay on their respective network. That means the cash only circulates on the cash network, and the securities only circulates on the securities network. And that's not like a bridge, for example, which would allow tokens to go from one blockchain to another, if we simplify. Then we have 2 parties, Alice and Bob, and they want to realize a DVP where Alice is the seller of the securities and Bob is the buyer of the securities. And both Alice and Bob have an access to the 2 blockchains. Now that we have in mind the configuration, let's see how HTLC actually works. The principle of the HTLC is that Alice locks her securities in a smart contract using a hash. Bob locks his cash in a smart contract with that same hash. And then Alice claims the cash using the pre-image of the hash, which reveals at the same time the pre-image and allows Bob to claim the securities. But let's see in details the different steps that we have here. So we start with step 0, which is the off-chain agreement between Alice and Bob to define the terms of the DVP. And before initiating the HTLC process, Alice and Bob, so they must agree on the amounts of securities and cash to exchange, and also on other parameters I will introduce to you in a few seconds, such as the timeouts. At step 1, Alice generates a secret, and then she hashes it. She keeps the secret to herself, and she locks securities on the network 1 in a smart contract with the hash for a period 2t. And in fact, HTLC smart contracts are time-based escrow. So assets are only locked for a limited and predefined amount of time that expires at a given timeout, here after 2t. So both securities and cash HTLC smart contracts have a timeout and a timeout parameter, which represents the duration over which the assets will be locked by the smart contract. And if the timeout is reached, and the asset has not been claimed by the relevant party, then the asset is returned to the original owner. At step 2, Bob audits Alice's HTLC smart contract before moving forward. And the code of the smart contract should tell something like only Bob can claim the agreed amount of securities until period 2T is reached. And Bob checks this, and if he agrees with the conditions set by the smart contract, he then goes to step 3. At step 3, Bob locks CBDC on network 2 with the same hash than Alice and for period T. And Bob got that hash when he audited Alice's smart contract. In this example, we use T and 2T for respectively the cash timeout and the securities timeout, but other values could be used. The important idea here is that cash timeout must be strictly less than securities timeout in such a way as to always let enough time for Bob to claim securities once cash has been claimed by Alice. At step 4, in the same way as Bob, Alice audits Bob's HTLC smart contract before moving forward. And if she agrees with the term of the smart contract, she then goes to step 5. At step 5, Alice claims Bob CBDC using a secret S, and before period T expires. And when claiming CBDC, Alice reveals her secret at the same time. And of course, the smart contract checks that hashing the secret results in the expected hash before transferring the cash to Alice. And the claim of the CBDC and the sharing of the secret are done in a single atomic transaction. So that means that Alice cannot receive the cash if the secret is not revealed. And conversely, the secret cannot be revealed if Alice does not get the CBDC. So this is this all or nothing logic that makes it possible to deliver cash and securities in turn with a delay, because Bob has the guarantee that he will be able to claim the securities using the published secret. And the last step is step 6, where Bob claims the securities using the secret S. So that was revealed by Alice on the network 2. And he claims the securities before period 2T expires. Now we will explain how HTLC was implemented in a Venus experiment. I will first recall the definition. That's basically what I've explained in the previous slide. So HTLC is an interoperability protocol used to exchange digital assets without trusted third party and relying on smart contracts, which are used as a time-based vault to lock and secure funds. It allows a decentralized DVP solution without a trusted third party. It uses a cryptographic process that links private data, the secret, to public data, the hash. The assets are locked with the hash and unlocked with the secret. And the recipient can unlock the asset due to him on the condition of providing the secret within a predetermined time frame. Our HTLC has some specificities. We adapted the HTLC concept to a private environment because the DVP was between 2 private blockchains based on Hyperledger Fabric for Banque de France DLT and based on digital assets, DAML, for Goldman Sachs DLT. And the process is orchestrated by the buyers and sellers custodians, which have both on access to the 2 DLTs. There are 2 trust assumptions here. First one is that the the DVP instruction matching is done on the securities DLT only. The second one is that cash and securities custodians of the same investor, which can be different entities, they must trust each other about cross-DLT messages they exchange. And it is a fair trust assumption as both custodians represent the same investor, and therefore they share a common interest. I will explain in more details what happens on the next slide, but this is important to note right now that buyer securities and buyer CBDC custodian on the one hand, and seller securities and seller CBDC custodians on the other hand exchange messages to share DVP and HTLC related data between the two networks. And that's a communication between custodians of the same investor. So there is no cross-chain communication between the custodians of the buyer and the seller. So as you can see in the diagram at the top right, there are two communication channels. The first one is between the buyer security custodian and the buyer CBDC custodian, which both represent the buyer. And the second communication channel is between the seller's security custodian and the seller's CBDC custodian, which both represent the seller. We have identified some key feedback. HTLC is a trustless protocol, so there is no need for a trusted third party, and that implies a high level of security. HTLC allows conditional DVPs. In fact, HTLC does not achieve atomicity because it is an interactive process consisting of a combination, a series of off-chain and on-chain operations, and depending on the results, different states can be obtained at the end. For example, if the buyer is not able to claim the securities before their timeout, the seller will own both CBDC and securities at the end of the process. Because as we saw previously, if an asset has not been claimed before its timeout, it is returned to the original owner. So yeah, HTLC does not achieve technical atomicity, but it is fair enough to say that we have DVP atomicity under certain operational hypotheses. Because if the seller and the buyer ensure that they are fully operational during the HTLC procedure, then they are guaranteed to receive their respective assets. One other important point that I have already mentioned before is that there is an atomicity of a cash claim and secret sharing operations, which are done in a single transaction with all or nothing logic. And if these two operations are not done in the same transaction, HTLC cannot work. I would say that this is the heart of HTLC. One last point about reusability. The current implementation can be reused with all DLTs sharing the same hashing functions than DL2S. And that's because in order to implement HTLC, the two networks must use the same hashing algorithm to lock the assets. We will now describe how the two DLTs interface. The custodians exchange cross-DLT messages via APIs. So DL2S and the securities DLT, they both expose APIs. There are three messages that we call message 1, message 2, and message 3 to emphasize their order of execution. And these messages are sent automatically between the two DLTs. So there is no operator beyond them. Now let's see the content and the role of each of these messages. After having locked the securities on the securities DLT, the seller's securities custodian sends the message one to the seller's CBDC custodian in order to share the settlement instruction with the secret. And later, the seller's CBDC custodian on DL2S will be able to claim the cash using that secret he received from message one. After having audited the securities HTLC smart contract, the buyer's securities custodian sends the message to the buyer's CBDC custodian to share the settlement instruction with the securities timeout and the hash. And the buyer's CBDC custodian on the L2S will then lock the CBDC using that hash he received. Once cash has been claimed by the seller on the L2S, the buyer's CBDC custodian retrieves the secret, which is public now, and he shares it to the buyer's securities custodian via the message tree. And after receiving the message tree, the buyer's securities custodian claims the securities using that secret. I will now expose you some highlights we have identified. This setup is efficient, but it requires the implementation of several contingency procedures in order to manage some unhappy paths. HTLC is a secure protocol, but there are some operational risks which are not the same for the buyer and the seller. The risk for the seller is a leak of the secret after securities have been locked and before cash has been locked. And in that case, the buyer will be able to claim the securities without having to lock the CBDC. The risk is different for the buyer. Once cash is claimed on the DL2S by the seller, the buyer must absolutely claim the securities. And if he fails, the seller will then own both cash and securities at the end. And in fact, and that will be our last point, there are several ways to control this risk. We can implement automatic or manual contingency procedures or set up a larger HTLC timeout to make sure the buyer will have enough time to claim securities. We implemented a manual contingency procedure on the L2S for Venus experiments. In case of failure of the automatic sending of the message tree, a script was ready to be manually executed in order to send that message tree. It's time to conclude with the main highlights and main lessons learned from Venus experiment, but other experiments too. Blockchain and DLT technologies have reached sufficient maturity to become serious candidates for underpinning market infrastructures. CBDC issuance, circulation, ownership control, and supervision can all be securely supported at the applicative level, that means smart contracts, on both private and public networks. Interoperability has been successfully demonstrated between cash and securities networks and without a trusted third party. We have demonstrated the technical feasibility of cross-chain DVPs and between blockchains of different technology. The L2S solutions maturity allowed to instruct a real DVP of 100 million euros. And one last point, using DLTs makes DVPs more efficient as it speeds up the transactions finality.
Maybe to really conclude this presentation, some links and an opening. So links about reports that I previously mentioned during the presentation. So the global report published in November 2021. There is also about the first phase of experimentation from Banque de France, the report for Euroclear experiment that was conducted with Euroclear, a consortium of banks to assess the potential of post-trade capital market settlement operations in CBDC for French sovereign debt securities. And for this experimentation, there were both the currency and the securities on the same platform that was DL3S. And for HSBC, so in addition to the issuance and distribution of the CBDC, the idea was to experiment bond subscription in primary and secondary markets, including coupon payments, and the execution of cross-border and cross-network payments. So in this experiment, several networks with several technologies have been used, so Hyperledger Fabric and free Corda, interoperated through Hyperledger Weaver that is now being included into Hyperledger Cacti. And maybe just to open a bit about the fact that all the experience that we accumulated on the DL3S development and the things that we've done for Venice experiment are being currently invested in the pilot regime that is a text with the main aim is to have a temporary framework that should provide favorable context for the use of blockchain for financial securities in the interbanking context. And so there is the opening point for central banks for the settlement asset that will be used in this context. I will copy paste all the links mentioned in the chat for those that are interested to dig a bit more about what we presented. Still no report for the Venice experiment. So, but for the others, you have a lot of things to read for if you are interested to dig in it. So, thanks for your attention, and we are available for questions. That's because I see a lot of questions on the chat with some answers sometimes. I don't know, how do you want to proceed for this part?
Maybe I suggest that we continue with the presentation and then we take all the questions in the end. While at the same time we can try to answer the questions on the chat and bring up the ones that have not been answered at that point in time. Would that?
We will look at the chat and try answering some questions.
Perfect. Thank you.
Okay, very good. Thank you. So I start sharing my screen. Okay, so can you now see my screen?
We're still seeing Simon's screen. Simon, can you stop sharing?
He'll have to unshare.
I have to unshare. Ah, okay.
The previous person needs to. Who's the current person sharing the screen?
Yeah.
Clement, quarantine.
1 second, Ellie. Let me see if I can. Oh, there we go. Okay, you're good. We can see your screen now.
Oh, fantastic. Okay, so hi from my side. After the very nice overview of Clement and quarantine, I'm going to give on what central bank digital currencies are, the exact scope and deliveries on the Venus project. I'm going to give an overview of the Hyperledger Technologies relevance into the central bank digital currency topic, starting off with a very high-level architecture of a typical central bank digital currency system. It's, you know, that there have been more than 60 reports on central bank digital currency issued by different various central banks, and more or less majority of them agree of a two-tier architecture, assuming at the top level a wholesale central bank digital currency, facilitating exchanges of cash, but also securities, different types of financial assets between central banks and major commercial banks. We see tier 2 referring to a retail central bank digital currency, facilitating exchanges of cash between individuals or corporations, just like we do today with our banknotes that we have on our wallet and that we use to pay. And then on the last end, we do have the consumer that would, or the payment service provider that would interact through APIs to the retail CBDC network to offer a service to other consumers, individuals that would itself need to interact and interoperate with a wholesale CBDC network. Of course, a lot of requirements I already mentioned, not explicitly, but I mentioned interoperation, for example, being an important one. Interoperation between two different central bank digital currency systems, different partitions of the same central bank digital currency system even, but also interoperation between a central bank digital currency system and legacy systems. So this is an aspect that we know for sure will be important, and because of the variety of the importance that a system would be compliant to regulation, and to some extent regulation differing from country to country, we do expect different architects or different platforms to facilitate the requirements in different countries. Therefore, interoperation becomes even more interesting to address. Privacy is an important aspect, privacy of the payments involved, especially if we are talking about a system that will need to transparently validate transactions that appear in it, such that every participant in it can verify that this transaction was indeed honoring the rules of that asset management system. But at the same time, privacy needs to be combined with accountability. Namely, participants of the system should not be able to repudiate their participation in a certain transaction. So strong identity management already becomes a clear need in this system. I mentioned before, privacy with accountability need to coexist, and also in a way that regulation compliance is enforced. Transparency is an important tool to facilitate security, and resilience is another security aspect that needs to be strongly positioned in this set of requirements of a central bank digital currency system. When I refer to resilience, is ensuring that the system will do its work as promised, as intended, even in the event if some nodes in the system fail, like crash, but also in the case where nodes in the system, some nodes on the system get compromised and introduce arbitrarily messages into the system, trying to mess up possibly with the system's operation. So resilience for critical infrastructure of this sort is an important, and this is where distributed ledger technology could bring strong value. Scalability and performance are necessary for the wholesale central bank digital currency, was already mentioned before. Performance is not so challenging to address, but when it goes to this retail central bank digital currency, this becomes of critical importance and quite challenging to address, especially with all these other requirements being addressed at the same time. And we want to emphasize that it makes sense also to separate this set of requirements on the two levels. The governance level, which says who should be making decisions into to upgrade the system, changing the rules of the asset management system. So, for example, some threshold of cash that a particular entity in the system should own, or upper bound of this sorts. So who should be authorizing the issuance of new money into the system, and so on and so forth. So governance have their own subsets of requirements to address, again, around compliance, privacy, and accountability, but also resilience. But it's also another level is when it comes to decisions that have already been taken to be enforced. Then it comes to the execution side, where again we have distributed setting that brings a lot of advantages, as we will discuss later, and where again we will need a system to support the transaction processing with high degrees of resilience. And to meet all these requirements is not an easy thing. We know from cryptography and security, there are ways that one could combine privacy and transparency. For example, we have primitives, cryptographic primitives like zero-knowledge proofs or secure multi-party computation that could be used, but these come with certain overheads, computation overhead, and they need to be treated with care. So to meet, to have a system that would accommodate all these requirements in combination, it makes sense to do a full technology stack investigation. Understand the application very well, work with domain experts to extract the real detailed requirements and threat models, which party in the system can be trusted, which party cannot be trusted, and for what. And using that information, one could build middleware components and libraries like ones that are evident that we need here are the ones around identity management and the ones around asset management, like token exchange, all the way to incorporating certain capabilities into the platform level that, in this case, it is represented by distributed ledger technologies, and in particular, Hyperledger Fabric. Ideally, one would also need to engage with dedicated infrastructure, optimized hardware to speed things up. But the important point is that one could not possibly address all this in a practical system from a performance and scalability perspective just by looking at the application side or the library side. One would need to look at the system holistically. And just to say a few words, and we will cover here again how privacy preserving decentralized asset management is an important building block. Angelo and Kautar will cover the token SDK and Fabric smart client combination that meet this, but also need to be combined with a secure privacy preserving identity foundation. Because of this requirement, the requirement for accountability, strong identity management is important. And I will also say a few words of Hyperledger Fabric and what are the characteristics of the platform that make it more than relevant, and the preferred DLT for this CBDC, at least experimentations we've been involved in. So our speakers before Corentin and Clement already mentioned the industry confirmations about the relevance of distributed ledger technology into central bank digital currency. I'll summarize it here. This distributed ledger technology brings value in business networks in three ways: through the distribution of trust, building trust essentially across a set of participants that are not necessarily mutually trusting each other, transparency, and automation. In this particular case, the use of DLTs significantly increase the ability of the system to be resilient to nodes that are under cyber attacks or insider attacks. So resilience of the system to compromised nodes, that automatically allows the operational risk and related cost to be reduced as well, because the system has a stronger guarantee that it would work well. Because of the combination of the distribution of trust and a high degree of resilience and transparency, one would argue that it unlocks the ability to leverage what is listed there, the smart contracts that are used there, in order to automate the processes. And that automatically allows, together with the transparency, as mentioned before, the reduction of the reconciliation time between issuers and security depositories and custodians and clients, all the way resulting into much shorter trading cycle. Trade to settlement cycle to essentially 0 days within the same day, at least, compared to today that it would take at least a couple of days to take place. Last but not least, because of, again, of the transparency that it brings into the picture and the fact that the single ledger is acting as a source of truth traceability, it was also being enabled, and overall reconciliation would be better optimized. So that's in short, and these are an overview of Hyperledger technologies that can be brought together in order to meet this set of requirements that were mentioned before. Of course, I mentioned the identity management, and there we have a strong representatives on Hyperledger, Ursa, and Iris, and indie projects. We have interoperability frameworks. We have Cacti, a Hyperledger project that allows general purpose platform in interoperability, the platform agnostic interoperability mechanisms it's mentioned, but also Hyperledger Lab Weaver interoperability protocol that was recently merged to Cacti project, or is to be merged. And then we have Hyperledger Fabric Token SDK that is combined with the Hyperledger Labs Fabric Smart Client, two things connected to what higher degrees of flexibility and privacy into asset exchange on top of Fabric. And of course, on the platform side, we have Hyperledger Fabric, Hyperledger Orion, Hyperledger Fabric offering decentralized consensus-based transaction processing. Hyperledger Orion offers transparent, centralized transaction processing. And moving forward, we will focus our discussion on these two parts: Hyperledger Fabric Token SDK and Smart Client, as well as Hyperledger Fabric. I'm not going to dive deep into the Token SDK because Angelo and Kautar have lots to say about this. I'm only going to emphasize on a few distinct characteristics of these components that were made that technology relevant to the DL3S platform that was mentioned also before. The main characteristic here, and asset management has been very long investigated into the decentralized trust community, blockchain community. It's quite straightforward what one is to check in a given transaction that moves an asset from one party to the other, especially trivial like conceptually, not in practice, I guess. One needs to implement it as no trivial. But the idea is that one needs to check whether the owner, or the current registered owner of the asset, is the one authorizing the transfer, and that during the transfer there is no new money created. If I own $1, I can spend at most $1. I cannot spend more. And this is essentially being converted by the community into a privacy-preserving setting where everything is concealed, but everyone is able to check that at least it's the owner of the asset that has been authorizing the transfer of its, and that the value, the balance property, essentially no new money is being created upon transaction, is being preserved. In the enterprise setting, which is again compatible to what we mentioned, the central bank, the wholesale central bank digital currency would look for, we go one step further. In addition to the privacy that the open source community, the open system community has built, we restrict that privacy into the permission setting. We enforce strong identity management of the individuals and accountability, and allowing that dedicated auditors that can be user dependent or type of asset dependent are able to view the history of transactions that refer to that user or to that asset. So audit support is the way we extended that, but also with strong identity management. Okay, just need to. And this is essentially the token SDK that is offering this kind of unique state-of-the-art capabilities, privacy and audit support differentiators, but also they offer some support for interoperability. Hash time locked protocol that was mentioned before is something that there are hooks into that such that it can interact with another system supporting that protocol. But two important things we also need to mention here. Three, actually. First is that architecturally, it's agnostic to the underlying DLT that is using. So it's primarily attached to Fabric, but it can also work with other DLTs. And the second thing is that it does support the UTXO model because of the privacy advantages that this UTXO model comes with. Third thing, equally important, is that it is not just a system that we built, a prototype that was built and was put under Hyperledger Lab, but it is also the protocol itself has been reviewed by the scientific community. And it's out there in detail. The cryptographic protocol can be reviewed, and the technology has already incorporated into mature central bank digital currency experimentation, including the DL3S and subsequently to Venus projects that were mentioned before. So just a few words just to conclude on the relevance of Hyperledger Fabric for central bank digital currencies. Again, one question would be, okay, why would you use a permission DLT for central bank digital currencies? Our view there is depends on the governance mechanism that would be desired in this setting. We do see central bank digital currencies requiring, to a large extent, control to be on the central bank side, or they're decided upon participants. And then control we refer to not only on whether they will decide to issue a currency, so the governance side of things that we mentioned before, make decisions on whether new money is going to be issued or a new securities are going to be introduced into the system and what are the terms for that and so on and so forth. But also the transaction processing layer. What happens if there is a bug into my smart contract that has been developed and some money have already been transferred by an attacker that has leveraged that bug to another address that nobody can get access to or cannot easily blacklist? So the governance side is important. If you remember in the past, this has happened. Like 2016, if I'm not mistaken, or a year later, and it led to forking the public ledger system that was there. So governance is an important reason, and control on the depending on the preferences or the specifications of the level of control that the central bank and the commercial bank should have in such a system, an appropriate technology would make sense to be used. So Hyperledger Fabric is able to leverage, comes with a very modular policy framework, allowing policies to be set for different levels of the system. We have governance mechanisms or policies governing how the overall system would be upgraded, or individual components in the system should be upgraded, ranging from the membership components all the way to upgrading of a specific smart contract in it, and so on and so forth. So it has a very advanced policy framework addressing a lot this enterprise need for specifying authorization of different parties in there. We also have modularity, and agility in the way the system has been architected, modularity on the crypto components, on the membership components, allowing an easy, smooth transition of the system to another crypto library, or even to post-quantum, quantum safe crypto libraries that will come up at some point. The need will emerge at some point in time. There are already mechanisms support GDPR compliance in the system. And we also come with a strong state-of-the-art performance and scalability aspects, and I will say a few words about it in the next slide. A lot of the operation of the system, and I say this because it's also important in our view as researchers, is that the system is there and works, but it is also backed with a very thorough report that has been published out there in the top-tier scientific conference and has been reviewed by the distributed system experts. So it is well-founded on multiple aspects in multiple ways. And this is to talk about the throughput of the system. And actually, these numbers are a bit outdated, but Byzantine fault tolerance is the consensus algorithm allowing strong resilience to faulty nodes that not only crash, but can also become assumed compromised, exhibit an arbitrary behavior when it comes to processing transactions. So this is definitely a desired property in the system, and we already have a smart BFT included into Fabric in an early version of it. But our plan is really to go into near BFT, an insanely scalable state machine replication algorithm that would allow a transaction throughput to go in the level of multiple tens of thousands of transactions per second, even with a number of participants beyond 80. Traditional Byzantine fault-tolerant algorithms tend to degrade throughput-wise once the number of participants go above 10 or 20, and that's what you see here. But this is not present in the algorithm we're moving towards. Last but not least, I mentioned identity being the needed foundation of a secure asset management system, and in particular, identity mechanism that would allow privacy preservation, but with accountability properties, strong accountability properties in place. Hyperledger has been very active in that space. We've seen a non-credits protocol, Hyperledger Else, Hyperledger India, and URSA, of course, projects are associated to that. And we've seen a lot about a non-credits specification protocol allowing this combination of privacy and accountability. I also want to mention decentralized identity comes with strong advantages on the scalability and privacy side of things, since the users are the ones owning the level in which they will interact with their environment, share information with their environment. There is no central authority that needs to get access to all the information about the user. And leveraging such a mechanism, connecting that with asset management is very, very much relevant in that context. And identity mixer technology that was also mentioned before is an early version of this kind of cryptography that is used in Hyperledger Hyperledger, it's provided in URSA, but also used very much in the non-creds credentials. With that, I'll hand over the word to Angelo and Kautar to do a deep dive to our assets. If there are any questions to be raised on the site, I will take care of the questions on the chat. Okay, Angelo, okay, I guess I need to stop sharing, right?
Yeah, okay, I'm ready to share.
Thank you, Ellen.
Let's see if I can catch this.
We've got your desktop. There you go. You're looking good, Angelo.
Very good, great. Okay, sometimes it goes crazy. All right, very good. So let's now take this move to this other phase of this other section of the presentation and have a deep dive in one of the core assets that was that is behind all the efforts that have been described so far. It's the Fabric Token SDK. I put in parentheses Fabric because it's true that it was born in the context of Fabric, but over time it evolved to become something that is agnostic to the backend, and I will show you why. So for this session, I want to talk about the privacy and the auditability part, the technology stack, and I also want to show you what it means to have what's the transaction life cycle for the token SDK. But before the deep dive, let me first locate where we are in terms of the stack, and also give you some other highlights to better position the token SDK. So this is what Ellie presented before, just a few minutes earlier. So we are there at I will talk about the centralized and the regulated tokens. So the token SDK sits in that at the middleware component. So from it talks to the token SDK talks with the platform, so with the backends to have the operations settled, to retrieve information from the backend as needed, and it offers API to the application layer in order to perform token related operations. All right. I also like to go back to this slide that Ellie just presented to spend a few seconds on a fact that CDBC, depending on the requirements, might require different level of privacy. Right, so these are Ellie told us about these three examples, and and the last one where you have also auditability, but you might have even other kind of combinations depending on the specific use cases, depending on the privacy that you want to achieve, or your system is able should sustain. You might have certain compromises in certain cases, or you want to go for full privacy no matter what in other cases. So for us, this was an important point, because we thought, okay, we need to be flexible. We need to design a system, a stack, an asset that it's flexible enough to adjust to different requirements without us having to rewrite the application continuously. So every time we change the requirements, we have to rewrite the application. So definitely this was not a goal for us. We wanted to be able to reuse the same API no matter your requirements or the specific requirements for the use case. So that's the reason why the Fabric Token SDK was born. We wanted to apply all the cryptographic. We wanted to make it real. The use of all these cryptographic protocols that we designed over the years in a software stack that would have allowed us and any developer to create quickly token-based applications. At the beginning it was on Hyperledger Fabric, but then we quickly switched to an infrastructure that can allow us essentially to swap Fabric, to change Fabric with other DLTs, or even centralize the system by all means. It doesn't, from the point of the token SDK, it doesn't really matter. Let me go again. Ellie gave already a heads up on the main highlights of the token SDK. Let me go again through them and give some also motivations on some of these points. So we decided to go for the UTXO model for a very good reason. The UTXO model is the one that gives you the maximum privacy possible. You can achieve some certain privacy guarantees in the account model, but you have to compromise in a way or in another. There are compromises to be made. The UTXO model instead is very amenable to be protected in all aspects, and to really simulate some key security privacy properties that you have with the real world, with the real cash, with your bank notes, and so on. The token SDK takes care automatically of the wallets and the key management. So you can use HSMs to store keys, or you can use a different infrastructure to store your keys, or you can just have on the file system as well. But the token SDK takes care automatically of all these things. You don't have to worry about that. It supports also multiple privacy levels. So from an instantiation that has no privacy at all to instantiation that have all sorts of that employ zero knowledge proofs to obtain different flavors of privacy depending on your specific use case. And this is possible keeping the token SDK API the same. Though we will go later in some details about the token API. I will give you also some example in terms of code, what it means to use the token SDK API. The point really here is that the principle is write once your application and then decide when it's time to deploy the system which kind of privacy you need and you want for your system, but the application remains the same. We have included in the token SDK this auditability support, so concepts like auditors that can look at the transactions and see what's going on. The API is flexible enough to handle both fungible and non-fungible tokens. So you can really play not just with you can use the token SDK not just to implement coins, so the digital currency of different flavors, but also to handle non-fungible tokens. And it has embedded support for interoperability. Kautar actually after this section will go more in details about the interoperability capabilities that we embedded in the token SDK. All right, so we are talking about tokens, UTXO. Well, what's a token from the point of view of the token SDK? It's very simple. It's the following triplet. So we have an owner, and this owner essentially defines what it means defines the concept of ownership of this specific token. So in the simplest case, it can be just a public key, or it can be something more complex like a script, and so on and so forth. We have a token as a type. It's essentially the denomination of the token, but it's really just a string. So you can put inside this string whatever you want. You can even load the type with a JSON structure representing your non-fungible non-fungible token. Then we have the quantity that in a sense represents the amount of value depending on the type. Of course, you will give a meaning to this value, but the amount of value that is stored in this token. So the value is clear if we are talking about currencies. So the type will represent a clear denomination. I mean, it can be cents or units, whatever it is, and then the amount, it's clear what the amount means with respect to the type. So then these tokens are fungible with respect to the same type. So if you have two tokens of the same type, that for you these are fungible. These are representing the same entity. So you can two tokens of the same type of the same amount. They're absolutely fungible. You cannot distinguish between them. If the tokens are different, if the types are different, then essentially what it means that you cannot merge these two tokens, so you cannot perform operations like merging, or you cannot, if a token is non-fungible, you cannot split this token in multiple other tokens. So very simple definition, very clear, not too really to the point, and not only it's easy to, this definition is general enough to model multiple type of tokens, but it is also simple enough for us to implement the zero knowledge proofs that are needed to deliver the privacy. So this is the stack of the token SDK. You can see here the two main components forming the entire stack. It's the Fabric Token SDK and the Fabric Smart Client. These are two Hyperledger Labs projects, so two different repositories. But personally, in my mind, I like to think about them as a single stack that provides this application, this SDK to build the token-based applications in a way that it's very close to the business logic. You will see later an example. So I think this was the other important aspect for us. Zero knowledge and advanced cryptography like multi-party computation or threshold cryptography are very complex to handle in practice. So we wanted also for ourselves, we wanted to have a system that would take care of all these complex aspects. So give us a very simple API. This was the request for the token SDK. Give us a very simple API to talk about tokens and take the rest, take care of all the details of what it means to generate zero knowledge proofs, zero knowledge proof here and there. So in a bit more, going a little bit deeper, we have multiple layers. The token SDK has multiple layers. In the stack, there are multiple layers. The top one is contains essentially what we call services that are libraries or pre-packaged software components that allows the developer to build quickly token-based application. So this is the part that is the super customizable, because if something is not provided, you can build by yourself, and you can put this as an add-on for the token SDK. These services will use directly the token API, so are built on the token API, and the token API is essentially backend agnostic, and also I would say privacy agnostic. So the token API gives you a way to describe operations over tokens and nothing else. Then the calls to the token API are translated to calls to a lower layer that we call the driver API. Now, it's the driver that does the dirty job. Essentially, it takes care of all the complexities of the zero knowledge proofs or any other technology that you might want to use. So through the driver API, we go to the driver, to the specific driver implementation that again can give you the flavor of privacy that you need. From in the open source project, we have two drivers that you can use right now. One that we call Fab token, essentially doesn't have any privacy, so everything is in the clear. Anyone who looks at the ledger can see exactly who did what. And then we have a version of the Zcat that Ellie described quickly, without graph hiding. I can go in more detail later what it means. Me and Kadro can describe in more detail what it means, but it's just a flavor of it's just a driver that supports zero knowledge and protects certain part of the tokens. So this structure, this API, this layering of the token SDK allow us to quickly change the driver once we need. So we can upgrade the system to new drivers, or we can even switch at the beginning. We can decide what we want to use. And the token API allow us to say to implement applications without having to worry about the underlying driver implementation. So we achieved the goal that we wanted: write once your application, forget about the backend, forget about the privacy that you are, the complexity of the zero knowledge proofs, and so on and so forth. Just focus on your business application. Now, how do we run this guy? So the stack can be executed as a standalone network node, and in this case, you will have or you will have a topology like this. So you will have multiple nodes that are running the stack. We usually call them FSE nodes, but no matter what, these are nodes that belong to the application, to the application system, to the application layer. And these nodes not only talk to each other, but they also talk. They can talk to multiple backend at the same time. So you might have multiple Fabric instantiation, an Orion instantiation, a Bezo instantiation, and so on and so forth. So you can handle all this a topology that is complex as complex as this one. But you can even embed this stack in your existing application. This was the approach used in the L3S. So there was already an application stack there. The token SDK stack has been simply embedded in this already existing application stack. So maximum flexibility. You can you don't have a single way to deploy the smart client. Now, let me tell you more about how do we achieve this decoupling of the actual implementation of the token, so the details about the zero knowledge proof or any other technology that you want to use, and the token API, the way we talk about tokens in the context of the token SDK. So we have an object, a data structure in the token SDK that it's called the token request. So let's go through. Let's see the anatomy of this token request to understand what it contains. So the token SDK, the token API speaks about the token request. So it knows how to manipulate this data structure. It doesn't know anything else, at least from the point of view of the token API. So there are three main sections in the token request. There is an anchor. Just to understand the anchor, you can think about the transaction ID in the context of Fabric, or any unique identifier for this specific request. Then we have a section dedicated to the actions that we want to perform. So the two most fundamental actions in the context of the token SDK are the issuance and the transfer. So issuance allows the possibility to allow someone, an issuer in particular, to create new tokens out of the blue. So they have a specific section inside the token request to specify the will to create new tokens. And tokens can also be transferred. So there is a section in the token request that speaks about the transfer of tokens from from a sender to a recipient. Now, the actions are also accompanied by witnesses that are needed to convince a validator that these actions are correct, so are legitimate. Think about the fact that if Alice is transferring a token to Bob, Alice needs to prove that she's the legitimate owner of the tokens that she's trying to transfer. So in the witness section, you will find a signature from Alice. For example. And then we have the metadata part. The metadata part, it's very important. It's something that it's used to transport all these little secrets that are needed to deobfuscate the zero knowledge proof. to better understand the content of the actions, right? So the actions might contain something like zero knowledge proof or cryptographic commitments, something that is obfuscating what's going on, because we want our system to be private. But when Alice and Bob are exchanging this information, for them the content of the action should be like it was in the clear. So the metadata is the section when Alice and Bob are exchanging secrets that allow them to understand the actions that they are discussing. So this is the main data structure that is in the token SDK, and it's used. It's manipulated by the token API. Then, when it's time to store, to make it real, to make these actions happening and being settled in the back end, we have the concept of token request translator. So now there will be a translator that takes this token request and converts it to the data format understood by the back end. So for Fabric, can be a read-write set. For Orion, it can be another data structure. Actually, Orion also supports a sort of data of read-write set. What is important is that the metadata are stripped out by the token request translator, because you don't want to store secrets right on the back end. These secrets are just for the parties who have been involved in a specific transaction. Let me give you more a better flavor by taking an example, so we understand also with the kind of information that are exchanged between these parties. Suppose that we have, let's say in this example, we have two parties, Alice and Bob. These are the classical names that we always use in cryptography: Alice, Bob, Charlie, Dave. These are the classical names that we use, so we always refer to them. So we have Alice and Bob. They want to exchange. They want to perform an atomic exchange. So Bob, Alice wants to exchange with Bob 5 USD. Actually, Bob wants in exchange of 5 Swiss francs. So what they do, what Alice and Bob will do, they will start talking to each other and assemble the token request by filling all the sections of the token request that I showed you before. So there will be a transfer section that contains the zero knowledge proof that Alice and Bob have constructed to prepare the transfer, and there will be in the metadata section something about something that deobfuscated the zero knowledge proofs, in a sense. Let me be very sloppy at this stage because we are not going into the cryptographic details. So once Alice and Bob are ready, they can sign the token request, so they can put their signature, their anonymous signatures inside the witnesses. And then this object can be sent to the backend for commitment, for settlement, and to have this settled. Sorry. So this is just a very high-level business use case that you might have that can be converted in actions in the token in calls to the token API. Now let me give you a sense of what's really happening behind the scene when we have Fabric as a backend. So on the left-hand side we have a bunch of people, business parties. We might have more than 2 business parties that collaborate all together in a peer-to-peer fashion. They come together and they decide they want to perform certain token operations atomically. On the right-hand side, we have Fabric with a chain code installed that we call the token chain code. This token chain code is creates the namespace in Fabric to store all the tokens that the system manipulates over time. So now the first step is for these business parties to start communicating and assemble the token request. I gave you before an example of a swap, but it can really be anything. You will see with the API. It's up to the developer to decide the particular business flow. Then at some point, this business party, they also have to collect all the required signatures. These are the signatures of the business parties, but can be one or more signatures coming from an auditor that must see the transaction before this can be submitted to the ledger, and so on and so forth. So once the token request is ready, what they do is that one of these business party will invoke the token chain code for a specific reason. So now this business party, they have the token request. They strip out the metadata because they don't want to leak these secrets to the blockchain. Now the token chain code does the following thing. It two specific things. It validates the token request. So it checks, for example, that all the zero knowledge proof are correct, that all the invariants of the payment system are satisfied, like only the legitimate owner must transfer the tokens, and no money out of the blue is created by the system. Notice that the token chain code, if you are using the driver that supports zero knowledge, the token chain code does not, and therefore the endorsers do not learn anything about the content of the transaction, because they see only zero knowledge proofs, right? So what they do, they validate the zero knowledge proof, and if they are all valid, they translate the token request to something that Fabric understands, the read-write set. Now notice that at this stage we cannot yet verify double spending, which is another key property of any payment system, because the endorsement, as you know, in Fabric, it can happen in parallel. Multiple endorsements can happen in parallel, and in parallel the ledger gets updated. So the double spending check can only happen at committing time. Anyway, we got the chain code invoked. The endorsers are responding back with the endorsement. The business parties now have everything to prepare a token transaction, to prepare a Fabric transaction and to submit it to the ordering service. So the transaction is submitting to the ordering service. All the committers, the ordering service ordered the transaction is distributed to the entire network, and as you know now, the committer are verifying essentially two things: that the transaction has been endorsed properly, so they check for the signature, and they check for the so-called MVCC checks, which are about conflicts of keys in the key value store. So this is the time where we check for double spending resistance. And how do we do that? We essentially the translation of the token request to a read-write set essentially will prepare a read-write set that will generate a conflict if a double spend happens. And if a conflict, so the committer will understand that if a conflict happens, this is essentially a double spend, and the transaction will be rejected. So now I know what you are thinking. This is very complex. There's a lot of steps going on. How will you ever? How can the API be so simple to handle all this complexity? So let me give you, and I agree with you. So things are complex because the system it handles very. It has many wheels to make it running. So it's complex for a good reason, I would say. But this doesn't mean that using it must be complex as well, right? So every day we're using our mobile phone without really knowing anything about quantum mechanics, even though these phones are using quantum mechanics in a heavy way. So we will try to do the same. And let me give you an example of what it means to write an application with the token SDK with the token SDK API. So usually you write what we call flows or views, anyway, units of computation that perform certain operation, and these units of computation are executed by the FSC nodes that I've showed you before. And essentially, it's the token SDK that takes care of executing these pieces of business logic. So remember that for us, the goal was we want something that doesn't speak about the underlying backend. We want something that doesn't speak about zero knowledge proof or any other privacy technology, trusted execution environment, multi-party computation. We don't want that level of complexity at the API. We want something that is very high level. So the first thing, if Alice has to transfer tokens to Bob, the first first thing that Alice would do in general is contact Bob and say, hey, Bob, I need one of your pseudonym because I have to transfer money to you. Why is this? Because Alice and Bob want to perform a privacy preserving transfer, right? So Alice will go to Bob and say, Bob, please give me one anonymous identity of yours that you will use only one, a pseudonym. Okay, this is the recipient. So Bob on the other side will prepare the pseudonym and send it back. Then Alice say, okay, I need to prepare an anonymous transaction because I don't want to leak anything about who is the creator of this transaction. And then in this token transaction, I want to perform a transfer that transfer tokens that comes from a certain wallet, tokens of a certain type that comes from a certain wallet for a certain amount, and I want to give this token to Bob. So one line, this is this transfer, this call to the token API essentially load the token request with all the relevant information. Now the token request is ready. We need to perform all that complex protocol that I described to you before. But from the point of view of the token API, we just have a single call that it's essentially it's the collect endorsements. It takes care of everything. Takes care of contacting all the business parties to collect signature, to contact the auditors, to contact the endorsers, the Fabric endorsers, or to contact anyone that needs to sign this transaction, depending on the specific backend that you are using for this transaction. And at the end, you want to order the transaction that you can understand as settled. Essentially, you want to settle at this point the operation. So it is that simple. All the zero knowledge proof, all the complexity of the backend are all hidden behind this call of the API of the token SDK. So if you are using if you are using zero knowledge, or if you are using trusted execution environment, or if you are not using any privacy at all, this code will remain the same. So this was very convenient for us and convenient also to develop the other applications. So here this is from the website, from the Token SDK GitHub repo. You will find multiple samples that you can go through and discover, play with them. I really encourage you to do that. So and give us feedback and even contribute to the Git repo. We are really happy to involve as many of you as possible. So last slide before I take maybe I answer. I see that in the chat there are messages, but before I take live some of your questions, let me recall you that the Token SDK is a set of API and services to develop token-based distributed applications very quickly, and with the motto write once, write once, decide later the backend and the privacy model. It's it uses UTXO model to represent the tokens, supports fungible and non-fungible tokens. It has a programming model that is very close to the business logic. You can find more documentation and samples on the GitHub repo, and you can reach us all on Discord on the Fabric Token SDK channel. With this, I will stop. Maybe I can either take live questions, or I can look at the questions on the chat. Let's see. Let me start from the last one. Can you please who installed the chain code? Very good. So the chain code is part of the setup of the Fabric. If you're talking about Fabric, that's part of the Fabric the Fabric setup. So I would expect that the administrator, one or more administrators of the network, and the four of the organizations in the Fabric network, they will receive the token. They will receive the chain code, the token chain code package, they will install on their peers, and they will follow the deployment the deployment path. How committers send the validation message to the FSC node back is all an FSC node. Very good. That's a very good point. So the FSC nodes will connect to a trusted peer in the same organization to learn about which transaction are committed. So essentially, the FSC node leverage the delivery service of the Fabric peers to learn about to learn about the status of each transaction. Of course, you need to take care because you want your FSC node to connect to either trusted peers or to connect to in the same organization, or to connect to multiple peers and to take the majority of their answer. Oh, but I feel now I see that also earlier answered. Oh, maybe I don't have to. I see there are already many answers, so maybe I don't have to take further. So this was my last slide, and now I think we can jump. If there are no other questions, so we can jump to Kautar and to see what it means to do interoperability with the token SDK.
Okay. Somehow I cannot start like video, but I think it should be fine. What we'll be discussing in the next, I think, half hour or so is interoperability in the token SDK. And okay, do you see my screen?
We can see your screen. It looks great.
Okay. So there are two use cases that we focused on for the interoperability in the token SDK. The first one is asset exchange, and this is what Corentin earlier, I think Corentin and Clément earlier touched upon, which is basically you want to exchange, let's say, CBDC for securities, and you want to have this exchange happens atomically, in the sense an entity can only receive the securities if they pay for it, and vice versa. And the second use case is asset transfer, and this is basically reflects the movements of assets from one network to the other. As Corentin and Clément mentioned earlier, in the asset exchange, we are assuming that the CBDC resides in one network, they will not leave that network, and the securities reside in another network and they will not leave it. Whereas in the asset transfer, the scenario we have is that the assets, you could imagine there is first network of CBDC, and then there is another network of CBDC, and that's somehow the assets, they will move from one network to the other. And you want to make sure that when the assets are transferred from one network to the other, that there is a preservation of value across networks. In the sense, this asset will be destroyed in the first network, and an asset with the same value will be created in the second network. And if this creation of asset fails in the second network, you want to make sure that you could actually roll back, let's say, the destruction of the asset in the first network. So the first thing we will start with is asset exchange. And we start with sort of like an overview, or let's say the basic use case that we try to address when we talk about asset exchange. So here we assume that we have Alice and Bob. So we have Alice in network A, and for simplicity, we say, okay, this network is for euros. And Alice and Bob, they are both in the same network. They both kind of can send and receive as like CBDCs in that network. And then we have a second network, which is network B, in which we have security. And the use case here is that Alice would like to exchange 100 euros for 100, let's say, bonds, and she agreed with Bob on that exchange. And what is very important to keep in mind here is that HTLC, or let's say this asset exchange, or the assumption in this asset exchange, is that Alice and Bob, they are rational and they are online. And it will become apparent why we have this assumption, like why they should be rational and be online, especially if we are using HTLC for the asset exchange. So I think Corentin already and Clément already described a bit how HTLC looks like, and here I will just sort of expand on that. So when it comes to HTLC, the first thing that would happen, or the first interaction that would happen, it would be Alice and Bob agreeing on the terms of the contract. And here the terms of the contract, if we go with the example I presented in the previous slide, would be Alice saying, yeah, I will pay 100 euros for 100 e-bonds. And then there are other elements that are specific for HTLC, and those are the hash and the timeout. So those are kind of also, let's say, in some way are part of the contract. And here, for simplicity, or like just for the sake of clarity, we would assume that Bob is the one computing the hash. So this is, HTLC is asymmetric in the sense when we start the HTLC, Alice and Bob, they do not know the same information. For example, in this case, we have Bob, he would pick a secret value X, and he will compute the hash of X. And Alice will only know the hash at the time when we start the HTLC. So Bob will compute this hash of X. He will send the hash of X to Alice, and Alice would, based on this hash of X, based on the timeout they agreed on, and based on the terms of the contract, which is like, yeah, I will transfer to you 100 euros for 100 e-bonds, it will create a transaction for Bob, and Bob will do also the same for Alice. And here, and it's something that is very important to keep in mind here, is that whoever knows the secret that is behind the hash should be the first entity to submit the transaction. So here we have Bob knowing the secret behind the hash. So Bob is required to first submit the transaction into this network where we have the securities, because Bob here would like to transmit the security. And the transaction that Bob would submit will lock the 100 e-bonds for Alice, and it will specify what we call unlocking conditions. And here the unlocking conditions are Alice reveal X before a timeout, which is in this case the double of the timeout they agreed upon, or if Alice doesn't meet this condition, in that case Bob would reclaim the bonds. So basically this means if Alice does not claim these 100 e-bonds before the timeout elapses, Bob could just go and reclaim the 100 e-bonds. Once Alice sees that this transaction was successfully submitted into the securities network, she will go and submit her transaction into the Euros network. So basically here, the unlocking conditions of the transaction that Alice submits is that, yeah, Bob reveals the secret key behind the hash, which is the hash of X, before the timeout elapses. Here, the timeout will be T, whereas in Alice transaction, whereas in Bob's transaction, the timeout was double T. And if Bob does not reveal the secret before this timeout elapses, then Alice would be able to just get back her 100 euros. So it's very important that this order of the submission of transaction is respected, because if we flip this order, what happens is that Alice would submit, let's say, first that transaction. Bob does not have to submit his transaction, because the moment that transaction is submitted by Alice, he can just claim it because he knows the secret key to claim the token that Alice locked in her transaction. So it's very important that whoever knows the secret of the hash is the first party to submit the first party to submit the locked transaction. So this is like classical HTLC, and the token SDK will provide support for this HTLC in a very simple, let's say, manner. So we kind of, the token SDK does not necessarily care about how these terms of the contract are kind of agreed upon. So as I said, the terms of the contract would be the timeout, the hash that would be used in the HTLC, plus the value and the type, and basically the sender and the recipient. So those terms are agreed upon, let's say, out of band. Although in the token SDK, actually, we provide mechanisms that allows one to have these interactions, but for simplicity, we just assume that we get this information out of band. And now we say that to support HTLC, the owner of a token in the token SDK can be an HTLC script. And an HTLC script is specified very simply. So it just have, let's say, 4 fields. Basically, it identifies the sender, it identifies the recipient, it has a hash and a timeout. And then a lock of a token and the token SDK corresponds to transferring this token to this HTLC script. So basically, this is a token whose owner would be this HTLC script. So if we go back to what Angelo presented, saying, okay, we have a token that has a type of value owner. To support HTLC, we do not have to change the definition of the token. We keep the definitions as is. We just kind of extend what an owner is. So in our case now, an owner could be an HTLC script, which is defined by 4 fields, where sender is an identity, recipient is an identity, and hash and timeout are just like a string and a duration. And we provide a simple API to kind of build the transaction for locking a token for the HTLC script. So we have the lock that takes the sender wallet, it takes the recipient, it takes the value, the type, and the hash and the timeout. So this is kind of very straightforward. And behind, let's say, and under the hood, what the lock does is actually it would create a transfer transaction in which the owner is an HTLC script. Now, there is the claim operation, which corresponds to the happy path. So basically, Alice and Bob, they are both online, they are both willing to complete the cycle of the HTLC script. So the moment they see a lock transaction, they would claim conditioned on them condition on them knowing the preimage of the hash in the script. So here the claim would just have the recipient's wallet. It will identify the locked token, and it will take the preimage. And why we do have the recipient wallet is that the unlocking of the token is not only show me the preimage, but also show me that you are the recipient identified in the HTLC script. So we say, okay, I have to see preimage, but this preimage should be actually sent by the recipient in the HTLC script. So the recipient needs to sign this transaction in addition to providing the preimage. So what the claim does is very straightforward. It will just transfer the ownership of this locked token to the recipient. So basically, we just sort of change the owner field. So the owner field now is no longer the script, is going to become the recipient. And again, the claim is just a transfer. So under the hood, the claim used the transfer that was presented earlier by Angelo. Now, this is the claim, which, as I said, is the happy path. So basically, both parties decide to just continue the protocol and sort of claim the assets. The reclaim corresponds to what you could think of as the unhappy path. So basically, for example, Bob submitted his transaction, Alice submitted her transaction, but then Bob, for whatever reason, decides just not to continue. So he doesn't submit the preimage. So in that case, Alice can reclaim her token, and the way to do that is just she sort of okay.
You should be good to go.
So here what we have, the reclaim, as I said, the reclaim corresponds to what we could think of as the unhappy path, in the sense Bob doesn't claim the token and doesn't reveal the preimage, then Alice just go and reclaim her token. And the reclaim, let's say, API is again very simple. We just have the sender wallet and the locked token. So basically we identify the token that needs to be reclaimed. And this reclaim would create a token whose owner now is the sender, which would correspond, for example, to Alice. And this reclaim transaction, which is again just a transfer transaction, would be signed by the sender. So as a verifier and the token, like as a validator of the transaction, if I see that this is a reclaim, I will only accept it if, first of all, the timeout has elapsed and if it was signed by the sender of the locked token. So basically by the initial owner of the locked token. Any questions? Okay, so just to kind of go back to the point about being online and rational, is that when it goes to, when we talk about HTLC, we have these timeouts. So we have the timeout, for example, if I go to the previous slide, we have this timeout, for example, T. So we could easily imagine that if Bob reveals X right after T elapses, like he wanted to kind of claim, but for whatever reason the transaction was delayed, and or he just kind of did not submit the transaction like as early as possible, what could happen is that Bob would reveal X right after T elapses, and then he cannot claim, because the condition is that like you have to make sure that you submitted it before the timeout elapses. But then Alice now has X, so she could claim it, the asset that Bob locked for her, because especially if this timeout, this double T has not elapsed. So you could run into this case where Bob could not claim the token, but Alice was able to claim the token. So it is very important that like the moment we see the transaction submitted, we have to go and claim them. So we should not wait until last minute, because we could actually end up in these situations where I claim, but it's just a little bit too late. So I cannot really claim, whereas the other party could go and claim the asset I locked for them. So it's very important to kind of, this online condition is very important. So it cannot be that like, yeah, I submit the locked transaction and then I go offline. You submit the locked transaction and then you kind of try to submit the claim transaction as soon as possible. Okay. So now I move to the asset transfer. And as I said, the asset transfer is more about moving assets from one network to the other. So whereas in the asset exchange, the assets stay in the same, they do not like change networks, let's put it this way. So the way we implement asset transfer, or the way we think about asset transfer, is that to implement it, what we do is that let's say we assume that Alice would like to transfer 100 euros to Bob. However, Alice is in network A, whereas Bob is in network B. So they do not reside in the same network. So Alice cannot just send the asset to an address in her network, because Bob is not part of that network. So what Alice does is that, like, say, okay, I will send the asset cross networks. However, it's very important to ensure that, like, when Alice sends this asset cross networks, that the asset is destroyed in her network and it is created in Bob's network, and that this destruction and creation of asset is atomic and also preserves value. So if, for example, the creation of the asset phase in network B, Alice should kind of be able to kind of reclaim her asset in some way. So because the transferred phase, now she should be able to just like get back her token. So this is what we kind of specify here, so that across network transfer could be understood as a redeem in the origin network or in the network of Alice, and an issue in the network of Bob. And what is also important is that to ensure that the values that are being destroyed and created are the same. So again, when we go back to the token SDK and what Angelo presented, the token SDK has tokens that are defined just as owner type and owner type and value. So we do not have anything that is sort of dedicated for cross network transfers, and we do not really want to extend the token definition just to support this. But what we do is that we say, okay, the owner in the token SDK is quite flexible because it's just a stream of bytes. And we say, okay, now we would specify an owner, which is a script, like what we did with the HTLC, and the script, we call it like a pledge script. And this pledge script sort of specify under which condition, let's say if we take the case where Alice, so basically Alice pledges a token for Bob. So the script would specify, okay, this is a token that is pledged for Bob. Bob is in network B. If Bob does not claim the token before a certain time out, then Alice should be able to get back her token. So this is sort of the conditions that this pledge script try to capture. So now if we go and sort of just try to think about the flow of this cross network transfer. So we start, as we said, like Alice would create a token for Bob, and it will specify a script that actually captures, let's say, this cross network transfer. And then Alice would notify Bob, because Bob does not have a way to know if the token was pledged for them, because he's not part of that network. So Alice would notify Bob and say, okay, I locked a token for you, and it will give him the identifier of this token. Again, because Bob is not part of that network, he cannot just like take Alice's word for granted, because Alice could just be lying. So what Bob does is that he uses a relay service, which is kind of provided by the Hyperledger Weaver. And this is a relay service that is trusted, let's put it this way, by his network. So Bob leverages this relay service to get a proof that actually there is a token in Alice's network that is pledged for him. So he would sort of contact the relay service, he will get this proof, and he would inspect that this token and the proof are valid and that the token actually corresponds to whatever he's expecting. And then Bob would contact the issuer in his network. So whoever is responsible for the introduction of tokens in the system, in his network, they will contact them, and they will contact them with the proof they have received from the relay service. Now the issuer would check that the proof is valid, and then they will check that actually the timeout has not elapsed, because as I mentioned at the beginning, Alice would specify a timeout before which Bob can claim the token. So if either the proof is invalid or the timeout has elapsed, the issuer would just reject. So he would just decide, okay, I'm not going to create the token. However, if these two conditions, if the conditions that is like the timeout has not elapsed and the proof is valid are met, the issuer would create a token that has the same value, that has the same type, and which is intended for Bob. And then it will also publishes in this, let's say, issue transaction, the hash of the token ID, which is the identifier of the token that was pledged in Alice's network, and the origin, which is the network in which this token was pledged, which is in this case would be network A, which is Alice's network. And why we add this hash of token ID origin is that to prevent Bob from claiming the same token twice. Because you could just imagine that like the issuer doesn't store this information, and then later Bob would just come again with the same proof, and they would present it to the issuer, and the issuer would just issue the token again. So it is very important for the issuer to keep track of the tokens that have been pledged. Okay. So now if we want to just sort of go across what we have, what is the information that we have in the script, and like what is the flow between the claim and the reclaim, we will we'll kind of, yeah, this is what we will be actually addressing now. So again, as I said, the pledge script specifies, as I said, that this is a token for Bob. Bob is in a certain network, and that this is the timeout. They also specify another information, which is the identity of the issuer and the origin network, which would help the sender to reclaim. So this is the case where, let's say, Bob, for whatever reason, they do not claim the token in their destination, in their network. And now Alice will say, okay, I see that Bob did not claim the token, or like Bob tells me that he did not claim the token. And I go and I sort of try to reclaim it, and I would have the issuer in my, let's say, in my network sort of creating again the value that was sort of locked for Bob in the pledge script. So again, like in the previous slide, we just talk about claims, whereas in this slide, we'll talk about claim and declaim. So again, a pledge token would rely on invoking this relay service to get a proof that says, okay, there was a pledge token pledged for Bob in Alice's network. Bob, then they will invoke their issuer with the proof, and then the issuer will check, yeah, this proof is valid. I see that the timeout has not elapsed. And then as a result, the issuer would submit an issue transaction that would create the token for Bob, and then it will add this unique sort of hash to the ledger to make sure that Bob cannot double spend. Now, if Bob doesn't claim, what Alice can do is that they will invoke the relay again, but this time the relay is more for the network of Bob, and they will get a proof that the token they have pledged, this kind of is a that this check, because it's very important, because we have to make sure that this relay service sends this proof of non-existence after the timeout elapses. So the relay service, they will send a proof that says, yes, I checked the ledger for this hash of token ID origin after the timeout has elapsed, because otherwise you could imagine Alice going to this relay service before, let's say, timeout elapses, and then the token doesn't exist in the ledger. Alice goes back to her network and say, you know, I have a proof that the token was not claimed, and then the Alice would kind of get back her token, whereas Bob meanwhile will go and claim, because he still has the possibility to claim because the timeout has not elapsed yet. So basically, it's very important to have this proof that it does not exist attached to the proof that the time of this query, whether the token existed or not, is larger than a certain transfer the ownership of a token to a pledge script. The way we do it is by calling this pledge function, which take the sender wallet, the destination of the destination network of the recipient, the deadline, the identity of the recipient, the issuer. As I said, this is mostly to help the sender reclaim in case some issues happen with the claim. And then there is a unique pledge ID, then there is type in value. And this pledge will create a locked token that has as an owner a pledge script. Then we have the claim method, and this is invoked by the recipient, and it sort of has a very simple, again, interface. So we have the issuer, we have the type, the value, the recipient, the identifier of the token that has been pledged, and the origin network, and then the proof. And here the proof is the proof from the relay network that says that the token has been pledged. And the reason we have the proof here included in the claim is more for, let's say, auditability purposes. And sorry, I mean, I mentioned that the claim is submitted by the recipient. It's not submitted by the recipient, sorry, it's submitted by the issuer. So the claim is the one sort of submitting this transaction. And again, the claim will just create a token for the recipient. Reclaim will transfer, again, as we said, the ownership from the script to the sender. And the way this is performed is by calling the method reclaim, which has as arguments the sender, the pledge token, the issuer signature that was received by the sender, and and the proof. And this reclaim will just create a token for the sender. Again, these are sort of a bit of a low-level methods, in the sense in the token SDK repo, we have applications that sort of handle everything you see here. So basically, you see a method that sort of orchestrates the interaction between the sender, the recipient, the relay service. So this is something that whoever is developing applications for this cross-network transfer do not have really to worry about, because it's taken care of by the token SDK. So we provide views that handle these application interactions. So it's not something to that, like, whoever is developing an applications that has something to do with cross-network transfer, they do not have to worry about this. Any questions? Okay, so with this, I conclude my presentation, unless you have any sorts of questions, either for me or for my colleagues.
Ellie, maybe back to you for a closing statement, or I'm keeping answering questions on the chat. Yeah.
Sorry, I was on mute. So thank you, Carter. Thank you all. I don't know if there are any questions that haven't been answered that you would like to bring up. Now we still have time to answer those orally.
There's always the Discord channel, don't forget.
Yes, there is always a Discord channel, and also we are all happy also to answer questions via email. So many thanks for your time attending this workshop. Hope that it was useful to all of you.
I see a question did just come in on the Zoom chat. Can you please tell if we provision the database as a service in cloud? Is it possible to connect? I think it is a follow-up question to one of the questions that are in the. Sorry.
Yes, no, that's fine. That's fine. Maybe the question of this one is this architecture or similar architecture being used by any federal governments in the world for CBDC implementation? Maybe Ellie, you can take that one.
So if you're referring to the architecture of a two-tier, like the two-tier architecture, I don't think I can answer this question. I know that it has been the recommended one by pretty much all of the central bank digital currency reports of central banks, and there have been more than 60 at this point. As I mentioned, DLT-based architectures for the wholesale CBDC there is consensus that there is alignment. In fact, I would say that for the wholesale CBDC, may have some information, but I'm unfortunately not able to share at this point because it's confidential. But I don't know. So, Nishan, if I'm pronouncing your name correctly, what level of architecture are you referring to? The two-tier architecture or a DLT-based incarnation of the wholesale CBDC, or the use of token SDK?
Token SDK. I meant, this is Sitaram Yakati. Yeah, whatever you presented right in the last slides. I'm wondering if that architecture or similar architecture being used by any federal governments in the world, because I know China they have implemented CBDC 1 year, more than a year, and India is in the initial stage of implementation. So I'm just wondering if any of them, or Japan is in plan. That's what we are hearing, right? Or other governments, some other governments. So I'm wondering if did they use this Hyperledger based architecture which you are showing as a use case, or did they use their own implementation of blockchain?
Okay, we'll restrict to say that there is definitely very advanced interest on the token SDK, but I'm unfortunately not able to say more than that. So wholesale and retail central bank digital currencies, stakeholders are much seeing with interest the token SDK capabilities, as I mentioned, because of the combination of privacy and regulation compliance, particular audit support.
What about other architecture? Whatever other ones you have shown? The other one.
The other elements of the architecture.
Yeah, the previous slides. I mean, before the token one, right? You have shown the initial demo use cases.
The Hyperledger Fabric. You mean the
full
stack?
Mm-hmm.
Yeah, so Token SDK, but also Hyperledger Fabric comes for wholesale central bank digital currency quite relevant, as I mentioned before. The same holds from, I mean, I don't know if David has something more to add as Hyperledger, but I know for sure if you use the central bank digital currency tracker, the web page, you would be able to see quite a few experimentation, at least looking at Hyperledger Fabric, but there are also some advanced versions of those. But unfortunately, I'm not able to say more.
Oh, okay. Okay. Thank you.
I'll just add one thing and I'll drop a link. I mean, in terms of case studies that we can talk about publicly, there are a number of published case studies on the Hyperledger website, not all of them necessarily related to CBDCs. It kind of covers a range of different use cases, but there are some deep dive case studies there, and some of them do touch on this topic. So you feel free to check out that link.
Oh, okay. Okay. Thank you.
And for the attendees, we are going to send out a thank you email with links to the video, relevant links. If we can get the decks from the presenters, all that will be up there. And you can also find them if you don't get that. We have a link to the wiki page for this event at the top of what I just put in the chat.
Okay.
All right. David, let me thank you very much for organizing all this. It's been great. Thanks a lot, David.
Yeah, well, thank you so much. I am glad there was so much interest in this topic, and thank you.
Thank you. Thank you, everyone, for attending.
Thanks, everyone.
Thank you, everyone. Thank you. Bye. Thank you.
Bye, everyone.
Bye. Thank you. And we can post questions, right? We can interact with you guys.
On Discord. Let's move to Discord. That's better there. Yeah.
Oh, okay. Great.
Yeah,
great.
so the
Thank
Zoom
you.
chat will go away as soon as this ends. But yeah, the Discord is permanent. Feel free to join on Discord, chat.hyperledger.org. And yeah, you can talk to people there for sure.
Cool. Great. Thank you.
Thanks, everyone.